Okay, hello and welcome everybody to my humble YouTube channel. This is, I think, the third video I've produced, and I just do these just kind of to help myself to kind of understand things by trying to explain them to other people, and obviously not to make money, just for the sake of maybe educating the earlier and the beginner traders. Now, I should say that I don't offer any kind of trading advice, and you should not take anything shown in this video in any shape, suggestion or form as trading advice, because I'm not a licensed fund manager. Okay, with that preliminary out of the way, here's my email if anyone wants to send me feedback. And I just want to quickly talk about three things today. Number one, should we trade with a stop loss? Well, let's just think about that for a moment. Do you think we should, or we shouldn't, or sometimes we should, or always we should, or never we should? Second thing is psychology of trading, and this is a very brief introduction today. And the third thing about what is money. So just three strange things I want to talk about today. Hopefully there'll be some beginner new traders out there that may benefit or learn something from this. If you're a seasoned trader, then probably you won't learn anything from this. So you can always switch to a channel where there are more seasoned mentors giving advice, but I'm just trying to do it, nice and simple for the beginners. Okay, so here we go. Let's just talk about the stop loss question, trading with a stop loss. Just got an example here. This is a whole day, June the 28th to June the 29th, of a particular instrument called the Micro E-mini Index Future September Contract 2022 year. 1 hour chart. And I'll come back to that in a minute. First thing is the question, should we use a bracket or not when we trade? So should we use a stop order? So for example, I'm going to do a trade now. I'm going to just buy the market, okay? Bang.
Order filled.
There you go. I just bought the market and I haven't even started. I'm already losing, what's that, 2 ticks or half a point. A point in the S&P E-mini is with 4 ticks. Now for the micro contract, then the point is worth $5. So right now I'm about, whatever that is, $3.50 or something down, or $2.50 down, $3.75 or $5 down. So do I need to use a stop? Well, I would argue yes, you should use a stop, and you should always use a stop, and you should automatically get into the habit of using a stop when you get into a trade. So why is that? Well, let's think about this. Supposing that right now the internet where I am, and I live in Melbourne, Australia, suppose the internet drops out and all of a sudden the price sort of, there's a war or something, and the stock market collapses and I'm left holding the bag here, then I could be liable for huge amounts of money. In fact, this can not only empty out my account, but sometimes if there's a gap or an overnight market or fast market conditions or a lockdown, then I may not even be able to get out of the position, and I can actually lose more money than I've got in the account. Say I had, say you've got a small account maybe with $1,000 in it, and you think, okay, I'll play with $1,000. Worst case, I lose it. Well, the fact is that when you're trading with instruments of futures or forex or anything, and if there is something nasty that happens, you can lose more than the money in your account. So if you've got $1,000 in there, you can still lose $1 million. And if you don't believe that, look at the kind of contracts and things you sign when you sign up for one of these accounts, and you'll see. So let's quickly, what you can do is you can get in there and say, put a stop market order, bang.
Order submitted.
Now it's protected. In fact, it doesn't matter. I could go away tomorrow and go to sleep now or whatever, and with a bit of luck, the stop will protect me, and I can't lose. Now, I remember in the early days learning about trading, some people were talking about stops and how the brokers would hunt the stops, and yeah, if you're going to be keeping a stop like about 1 tick underneath price like that, anything can happen. And I'm not saying it does happen, but you keep your stop far enough away that it's not going to be an issue. So let's close all this now. What I want you to
Order
do
filled.
is to get into the habit of, let me just, how was it? Oh, I think it's there. Sorry, I moved things around. I just put up a bracket here. So what happens now is that if I just buy, bang,
Order filled.
it automatically puts in a stop. This one I put 25 ticks below or 5 points below, and a target 75 ticks away. And the stop and the target are what are called OCO orders, or one cancels the other, so that as soon as you cancel, close one,
Order canceled.
you lose the other. So if you just get into
Order
the habit
filled.
of always using a
Order
bracket,
filled.
then you can now walk away, and theoretically the worst that can happen is it hits your stop and you lose your whatever that is. Of course, even more worse than that can happen. That's pretty bad English. Even more worse. Where did I go to school? Even worse than that is that you can actually, there could be something like some sort of a lockout of the market or something, and then the market opens up again an hour later and gaps up 500 points, and you've shorted it and you just lost your house. So even if you have your stop, that doesn't guarantee that you're not going to lose your house. So trading is a risky business. The best thing you can do to minimize the risk is always have a stop. And secondly, it is wise these days, I think, to not hold positions overnight, and it is really wise to not hold positions over the weekend. If you want to do that sort of thing, become an options trader, then you don't have to worry. But then you start paying for time premium and all sorts of funny money and stuff, and even that can get tricky too. But if you want to hold position long term, then you've got to use options. Okay, so that was my first kind of talk about always have a stop.
Order filled.
Hopefully that's clear. And second thing I want to talk about is the psychology of trading. Now, I'm not a psychologist, so I'm not qualified to talk about this in that sense. But I just make an observation about what I can see that could be of some interest. And the observation is this. Let's just go back. I had an area boxed in there somewhere. Okay, so that's a whole day of price trading there from here to here. I'll just get rid of this because it's a bit annoying. Okay, so maybe the day, here it is, June the 28th starts here. Let's do this. Where's that thing? Here. Okay, so the day starts at midnight and it ends at midnight. This is New York Eastern Time. Other people talk about the close when the market closes at whatever, 5 p.m. or something, but I like to use this thing which I learnt from one trader called ICT has always used the New York midnight as the reference time. Anyway, regardless of that, so what happens with the psychology of trading is that our mind plays tricks on us. Now, one of the tricks it plays is it says, you look at this the next day, and you're looking at this chart like I'm looking at now and say, well, it's easy to make money. Come on, all you have to do is say, sell at this point, and then just hold it to the close. Or maybe close it here, whatever you like. So how easy is that? And of course, if you traded that day, you might have not done that. You might have done something else. You might have you might have gone long and had a position and you were winning, and then all of a sudden you lost. But when you look at it the next day, your mind plays tricks on you and says, all you had to do was just sell it up here and buy it down there. When are you going to learn? Why are you so stupid? So we tend to, our mind plays tricks on us and our subconscious starts making things look as if they are easier than they really were. But the fact is that when you're at the beginning of the day, what have I just done there? Sorry about that. Now I've probably lost, I think the day was here. Yeah, there it is, there. Okay, so there we go. There. Here. Okay, here's the beginning of the day. At this point, you don't have information unless you got a friend who's a broker or something. No, I'm joking. They wouldn't know as little as I would know. But you don't know at this point, is this thing going to go up or down tomorrow? So what happens tomorrow? You wait and see, and then you find out, oh, well, all I have to do is sell up here and buy down there. So that's the psychology that I'm talking about, that your mind plays this trick on you. And it sort of comes about, I've come across this in not only in trading, but in many things in life. For example, maybe I understood how something, I have an engineering background originally, and maybe I understood how something worked. Then after I understood how it worked, I explained it to someone who wasn't as technical, and then they understood it. And then they thought, oh, well, that's easy. I could have done that. But no, they could not have done that. But people would trick themselves into thinking, you know, the airplane can float because it's got lift, and the Bernoulli equation and the pressure under the front and the rear of the wing, and excuse me, whatever it is. Once it's explained, it's very easy to understand why an airplane flies or floats. But if you've got to work it out for yourself, it's not all that easy. So a lot of things are like that, that after someone explains it to you, it's you know, clear as day. But before they've explained it to you, it's very hard. And the price action of the market is the same. Reading the price action in the moment is a lot harder than what the talking heads on the financial programs do, where they say, oh, well, yesterday the markets had a bit of a rally in the morning and traded up to a high, and then there was a bit of a sell-off on news of a merger or demerger of, you know, company XYZ, whatever. So those people that talk like that usually know nothing at all. And the good thing about trading, and I think this is the same with another area called the martial arts, or like boxing or fighting or street fighting, is that anybody can talk about how to fight, and block, and a left block, a right block, and a kick. But you go out there on the street and you get attacked by a couple of thugs, and then let's see if whatever you talked about in your theory of self-defense actually works. And 9 times out of 10 it won't work. So the people in the martial arts in the old days in China, what they would do is that you call yourself a master, fine, you set up your school, and then someone else who is a master might come along from another school and challenge you, and you have to either put up or shut up. And then one of them would kill the other one, and whoever was still alive was the winner. But at least with the martial arts, it's like that. There is no, if you can pardon my language, there is no bullshit involved. It's just, there's no BS, to be polite. You can't talk about it. You've just got to do it. And trading's the same. I mean, anybody can look at this later and say, oh, I should have just sold here and just bought down here. Just hold for a bit. Don't be too impatient to just take profits here or here. Just, you know, hold to the rest of the day there. Okay, so that's the kind of talk that our subconscious does. And the way we approach the market, I think if you look at the guy called Larry Williams, is an old trader. I don't know if he's still trading or he's retired now, but he wrote a few good books, and I love the things he talked about, because he really nailed it and got to the bottom of things in so many ways. And when he was talking about psychology, he said something that no one else says, and what he said is that the way you approach the market is influenced by your own background training. So for example, let's take me. I used to be trained as an electrical engineer. I would probably, you know, I have to admit that I did do this. I took all the data, I ran, you know, I stuck it into an SQL database, I ran transforms, wavelets, all sorts of things, game theory, tried to apply all sorts of things to it, thinking that I had a model and that the model would work. And neural networks, another one. Prediction, online prediction, autoregressive moving averages, all sorts of silly things, which don't work at all. But because I'm an engineer, I thought in those ways in terms of data models, and that they didn't actually work. because I didn't have any kind of inside information about how the delivery of price actually occurs. Now, another person could be a lawyer. A lawyer, as Larry Williams would say, would be like always arguing with them, arguing with clients, and he would say, but the price up here, it's now, 10 o'clock. By now, it should have been not there, but the price should have been here. And you can argue all you like, but if the price is what it is, and if you have your money in the wrong place, then you'll get beaten up like the martial artist who says he's good at taekwondo, kickboxing, Muay Thai, Jiu-Jitsu, Aikido, Wing Chun, and White Crane, and Tai Chi, and one or two of these things which I've done myself. You can talk all you like, but when you get to the point where someone tries to beat you up in the night in the street, you're either going to come out on top or you're going to get yourself beaten up. And so the psychology is like that. And then there are, for example, what else is there? There's the lawyers, there's the psychologists themselves, and they'll talk about, oh, well, it's all, what moves the market is psychology. It's the sentiment, people were feeling bullish, and then later on something happened, and then their mood changed, and then they were overcome by selling, and it all started to sell off. So the psychologist will think that he or she has a model, and it's based on psychology. But, fine, you do that, see if it works for you. Okay, so that's another thing about the psychology of trading. I've only touched on it a little bit, but what I wanted to touch on was the fact that very first thing, that we have this kind of bias that we after we see something, or after someone explains something to you, then you say, oh, yeah, that makes sense. Like, after Newton was sitting under an apple tree back in England somewhere, and then the apple fell off the tree and dropped on his head, and he thought, why did that apple fall? Why didn't it just stay there? And because the gravity caused it to fall, and he started to formulate a theory of attraction of massive objects. And then after he explains that, everybody today said, oh yeah, that's basic, one of Newton's basic laws, easy. And it does sound easy, but you go back a few hundred years and no one knew that, no one understood that. So that's all I want to talk about in the way of psychology. So we covered two important things today. Is number one, always trade with
Order filled.
Oh, I'm just checking I'm on Sim. Yeah, I'm on Sim, good. Always trade with a stop, and if you want to be even smarter, have a bracket. Make sure that they're one OCO, so that if you cancel one,
Order canceled.
it cancels the other one. So
Order
never
filled.
ever trade without a stop. All right, now one last thing I want to talk about is what is money? What is money? It's a very complicated thing. Let's start with a little anecdote. My grandfather used to live in a small village. Grandfather on the father's side lived in a small village in Sicily, in Italy. And one of his friends, I think, went to maybe New York to, or somewhere in America, and was gambling, and then came back and he lost all his money. And he said to my grandfather, I don't know why I lost that money. And my grandfather, who had a way of calling a spade, he said to him, because you're an idiot. You think that when the people at the casino set the casino up, that they set it up with their business model so that they could give you as much money as possible? Or do you think maybe they were trying to fleece you of all your money? Well, the latter is the case. In those days, they were some shabby places, and their whole model was to take your money. It doesn't matter if they cheat or they don't cheat. Even if they don't cheat, the odds, they've stacked the odds in all of the games. Like in blackjack, even if you were the best player in the world, you can't get above about 49.7% odds in your favour. And the house always has that, the complement of that, the 50.3%. So there's nothing you can do. So even if the casino don't cheat, if you play long enough, you will eventually lose to them. It's just the law of numbers, central probability laws. So that's guaranteed. And what about the stock markets? What about the foreign exchange markets? What about the futures markets? What are these things, and what is money, and what causes the price why is, I don't know, I mean, I could be looking at maybe something else like the euro dollar or something. Why does it sort of go up and then it goes down? And who is it that can make that price go from here to here? What are the forces? For example, in my course of many years of trading, there were many explanations. Some people say, well, you know, when you get up here, then the sellers take over, and you can see that in the order flow or something, and there's more, you know, the offers get heavy, the bids get light, they start pulling bids, and or another person will say, oh, you know, that it's obvious, you know, there was actually an area up here which is a supply, and you've gone into supply, and then the price went down, and then the price action person will say, oh no, well, you see, what happened is you broke this pivot right here. Let's just change this pointer. Okay, you broke that pivot, and there's a shift in market structure. Now it's going down, and so on. So everyone and their dog has got a theory about why price goes up and why price goes down. And then you look at these things, and you look at it every single day. You know, the price sort of goes up and goes down, goes up and goes down. And you think, well, is there some model behind that as to how that happens? And many traders are selling a lot of courses and things out there saying that, yeah, we know it's because of whatever, this, or it's because of that. And in many cases, it's not like that. It's more like, I think, I'm not sure exactly who they are, some large banks or large financiers who control the money supply and are able to participate in moves like from up here to down here. I'm not exactly sure who that is, but if you have a look at some of the videos by the ICT character, just search for ICT, he's got a whole YouTube channel, and he explains his model of how all this thing works. And he explains that it's all about liquidity, and there are pricing macros and delivery algorithms, and some of the things he explains there he actually demonstrates with live trades, so you get the feeling when you're watching him that this guy really knows what he's talking about, either because he's worked for those people in terms of executing or writing the programming for the macros that do the price delivery, or some people have chatted with him about how things really work. Anyway, so he's come up with this concept called smart money, and basically, let's put it this way, if you follow that model, then the smart money people would have been accumulating up here and then selling off positions here, distributing and accumulating again, and so they're always on the right side. And if the model that he prescribes, which is probably the best I've come across, is that you should just try and understand what's happening with the so-called smart money and try and be on their side and don't go against them, because it's like you're like an ant and you don't want to be stepped on by an elephant. So do have a look at that, especially for the new traders. There is a model there about how all the price is doing is seeking liquidity, and then you ask yourself, well, you know, why, for example, is this low here a little bit lower than this low here? Well, that's liquidity seek, and so why, for example, this high is not as high as this high, and when you start thinking in those terms, that's the closest you'll ever get to having a model about how the markets actually work. So think about that, and good luck with your trading, and I'll stop it at that. Thanks for your time.